Welcome back to the deep dive. You know, if you feel like you're constantly hearing about trade wars, tech battles, energy scrambles, like it's all happening at once, well, you're not wrong. Today, we're going to strap in and connect the dots across three continents, really digging into the big shifts reshaping the global economic map right now. We've got a stack of analyses here looking at U.S. foreign policy clashes, critical energy infrastructure debates, and of course, that massive race in AI and semiconductors. So our mission today, pretty simple, really. We want to cut through all that noise and give you the key insights, those aha moments, so you understand how countries are actually reacting to all this pressure.
And that pressure, that's the key word. You see it running through all this material. The current U.S. administration's approach, these maximum pressure trade tactics, the America First angle, it's not just about imports anymore. It's fundamentally pushing other countries to find ways to stand on their own 2 feet, economically speaking. Every major player is trying to figure out how to, well, de-risk themselves.
Exactly. And maybe the most fascinating example of this, the strategic juggling act, is playing out right now in Asia. Let's start there. Our first high-stakes situation, India's strategic high-wire act. Yeah, the U.S.-India trade relationship. It definitely seems to have hit a rough patch. And the upcoming meeting between Putin and Modi really highlights that tension. You probably remember back in August 2025, the Trump administration slapped these pretty hefty tariffs up to 50% on some Indian goods. And they weren't shy about why.
No, not at all. The official reasons given were India buying lots of Russian oil and focusing on strengthening that BRICS group of countries.
The language coming out of Washington was, well, strong. Reports quoted the U.S. Commerce Secretary Howard Lutnick saying very directly, we need to fix India. But is India actually being fixed? Are they backing down? What's their play here?
That's what's so interesting. They're really not bending. Instead of giving in, the analysis calls it the my way strategy. I mean, look at the upcoming Putin visit to New Delhi in December. That's not just a photo op. It signals a clear commitment to deepening ties with Russia. They're working on securing long-term deals for discounted Russian oil. It's about energy security, sure, but also managing inflation back home.
Okay, and this is where it gets really interesting, especially on the defense side. The agenda for that summit is pretty stunning. Take defense, for example. Russia's offering something, well, unprecedented. They don't just want to sell India their advanced S-500 air defense system. They want to co-produce it in India.
And crucially, that includes full technology transfer of the TOE-T. That's huge. It means India gets the blueprints, the know-how to build it, maintain it, maybe even adapt it down the line.
Yeah.
It's a massive boost for their domestic defense manufacturing goals. Russia's and make India a global export hub for the S-500.
Which fits perfectly with India's Make in India push.
Exactly. And for Russia, it's a major way to sidestep Western sanctions. A win-win from their perspective.
And then there's the money side. They're working on strengthening the rupee ruble payment system. What's the goal there?
2 things, really. 1, tackle that big trade imbalance India has with Russia. But more strategically, it's a deliberate step away from using the U.S. dollar for these big transactions.
Yeah.
It's part of that wider trend of de-dollarization, bypassing the U.S. financial system where they can.
So if we zoom out, this is what they mean by strategic autonomy, right?
Absolutely. Think of India like a tightrope walker, perfectly balanced. They're in this unique spot. The U.S. feels it needs India, partly as a counterweight to China, so they can't push too hard. But at the same time, Russia needs India economically, politically, especially with sanctions biting. This leverage lets India play both sides, extract concessions, and actually lower its overall geopolitical risk compared to, say, other emerging markets.
Okay, so for you listening, what does this tightrope act mean if you're thinking about investments? Our analysis points away from just the usual suspects. Indian IT, pharma, the real engines of growth could be shifting towards defense.
Right. Companies like Hindustan Aeronautics, part electronics firms, benefiting from these co-production deals, and the Make in India policy.
And energy infrastructure. Think about the companies involved in refining and distributing all that discounted Russian oil, especially now that the payment system is being de-risked through that rupee ruble setup. Those sectors look structurally supported. All right, let's hop across the Pacific now to Canada. They're making their own big move towards, well, autonomy. Alberta is pushing hard for a second oil pipeline to the Pacific coast. They're calling it the Cascade Gateway. It's a massive project. Why the big push? Why now?
Well, the material suggests it boils down to 2 things, really. Fear and opportunity.
Okay, let's start with the fear.
The fear comes from recent history. Remember the Keystone XL pipeline cancellation by the U.S.? That was a huge shot for Canada. A painful lesson about relying too heavily on just one customer, the U.S., especially when that customer's policies can change so quickly.
Right. The rug got pulled out from under them. And now, with the current administration in Washington always talking about potential new tariffs, maybe even on Canadian crude oil, that fear is amplified. Suddenly, having an escape hatch, a way to get their oil to other markets without crossing the U.S. border, seems essential.
Exactly. That's the fear part. But there's also a big opportunity driving this. The existing Trans Mountain Pipeline expansion, the TMX, it's already proven something important. Exporting oil directly to Asia actually gets them a better price. Analysts call it the Asia premium. We're talking maybe $2 to $3 more per barrel compared to selling it south to the U.S.
So diversifying isn't just about reducing risk, it actually makes them more money.
Precisely. It confirmed that getting oil to Asia is profitable. So this new pipeline, Cascade Gateway, is like an insurance policy that also happens to be a potentially lucrative business venture.
Okay, so what's the ripple effect, geopolitically speaking?
If this pipeline gets built, it gives Canada a lot more leverage. It seriously boosts their economic independence, makes them less vulnerable to political winds blowing from Washington or trade threats. Ottawa gets a stronger hand to play. However, and this is important, it also sets up a potential new conflict down the road.
How so?
Because Canadian oil flowing to Asia will be competing directly with U.S. oil exports in those same markets. The reports we looked at suggest this could lead the U.S. to retaliate, maybe with trade actions against other Canadian exports. So it solves one problem, but might create another.
Interesting. But for investors looking at Canadian energy, what's the main takeaway here?
The core point is that this project structurally tackles the biggest political risk hanging over Canadian energy stocks, that over-reliance on the U.S. market, being able to access that Asia premium, reduce the political volatility. That could fundamentally lead to a re-rating, a higher valuation for Canadian energy companies over the long term. Plus, exporting more valuable oil, that's generally good news for the Canadian dollar, the CAD, in the long run, too.
Okay, let's pivot now to the absolute cutting edge, the semiconductor race that's fueling the whole AI boom. There's been some huge news recently around the Stargate project. OpenAI CEO Sam Altman signed letters of intent LOIs with Samsung and SK Group in Korea. This sounds big.
Oh, it's immense. And the sheer scale of what OpenAI is asking for tells you everything. They requested capacity for up to 900,000 wafers per month of something called high bandwidth memory, HBM.
Okay, HBM, remind us what that is exactly.
Right, so HBM is a special kind of memory chip, DRAM, but instead of being laid out flat, the memory modules are stacked vertically, like tiny skyscrapers. This lets data move super fast between the memory and the AI processor. This massive request basically confirms it. The winners in the AI race won't just have the smartest algorithms. They'll be the ones who can actually get their hands on enough HBM.
Yeah.
It's the critical bottleneck right now, the absolute choke point.
Which brings us to some really strange contradictions happening with U.S. policy, trying to bring chip manufacturing back home, the whole onshoring push.
Yeah.
The government's using the chip PSX subsidies as a carrot, but they're also hitting resistance, right? Like Taiwan pushing back on moving half their production here.
Yeah, Taiwan publicly said no to that specific target. And the administration's response, according to reports, was pretty stark. The U.S. Commerce Secretary apparently tied compliance directly to continued U.S. military support.
Yeah.
Essentially saying, want our protection, build chips where we tell you. And we're also seeing some reality checks on the ground here in the U.S. Intel, for example, pushed back the timeline for its big Ohio plant way out to 2030 or even later, citing costs, demand questions. It shows subsidies aren't a magic wand. Though, to be fair, there is one bright spot. TSMC's plant in Arizona actually turned its first profit in early 2025. So it can be done, but it's clearly not easy.
Okay, but this policy environment, it leads to maybe the weirdest contradiction of all. The government is pushing so hard to build these incredibly complex, expensive factories. And at the same time, they seem to be actively cutting off the supply of highly skilled workers needed to actually run them.
It is baffling, honestly. The industry itself is warning about a massive shortage, something like 67,000 professional roles needed in the next 5 years. Engineers, technicians, PhDs. Yet you see policies coming out like jacking up the fees for H-1B visas, the ones skilled foreign workers use by something like 100 times. In shortening time, foreign students on F-1 visas can stay and work after graduation.
It's like putting up a giant help wanted sign, but then charging people a fortune just to walk up and read it.
Exactly. It makes no sense. You're investing billions in the hardware, the factories, but simultaneously strangling the pipeline for the human talent needed to operate them.
So with all this uncertainty where the chips will actually get made, who's going to staff the factories, This policy chaos, what's the safest way for someone listening to think about investing in this space?
Well, if you're unsure about the where and the who, the logical move is to invest in the what. The things that are needed regardless of where the factory is built or who works there. We're talking about the picks and shovels of the AI gold rush. Focus on equipment and materials. The industry sometimes calls this the Sobujang sector, the specialized tools, chemicals, components needed to actually make the chips. Think companies like ASML, Applied Materials, Lam Research. These guys supply the gear, no matter the location. And the other angle, automation solutions. If you can't find or afford the people, you automate the process. So companies providing those advanced robotics and automation systems for chip fabs, they could see a structural boost from this labor crunch. Hashtag tag outro.
Okay, so we've covered a lot of ground. Three really powerful forces shaping things globally right now. We saw India navigating that geopolitical tightrope, using the tension to grab advanced defense tech and boost its financial independence. We looked at Canada building its energy escape hatch to Asia, chasing that Asia premium and trying to lessen its reliance on U.S. politics. And then the AI race, totally dependent on HBM memory, happening amidst these really confusing U.S. policies on chip manufacturing and skilled labor.
And the thread connecting all of this, the final takeaway for you, is that these aren't just random events. They are all, in different ways, direct responses to this really turbulent global trade environment, an environment heavily influenced by U.S. domestic policies and pressures. So what you're seeing is country after country trying to carve out more economic autonomy, more diverse trade routes, more stable supply chains, basically trying to insulate themselves.
Which leaves us with a final thought for you to chew on, something to think about. If technology like semiconductors and national security are now so tightly intertwined, we saw that with the Taiwan pressure, the S-500 deal in India, how can the U.S. expect to maintain its dominance over these critical global supply chains when its own trade and immigration policies seem to be actively pushing away key partners and choking off the supply of essential skilled workers? That balancing act, that feels like the critical question for the next decade of global competition.